Hello everyone, and welcome back to Stickman Speaks. War, sadly, has become a recurring theme in today's global news. We see ongoing conflicts in Ukraine and Gaza, rising tensions around Taiwan and China, and most recently, a spike in hostilities between Israel and Iran following targeted assassinations of key figures. The subsequent retaliation and the fear of further escalation, possibly involving the United States, have generated real concern. As tragic as all of this is, there remains a persistent belief in parts of the finance and investment world that conflict, despite enormous human cost, can boost the economy. You've probably heard claims like war creates jobs, drives innovation, or even stimulates growth. On paper, that sounds almost paradoxical. How can something so destructive possibly be good for an economy? With so many voices floating around, social media posts, pundits, newsletters, I wanted to take a step back and ask, what does history, across hundreds of wars over centuries, actually tell us about war's economic impact? In this video, we'll walk through decades of economic research and data to examine how war affects GDP and national output, the consequences for labor, capital, and trade, the long-term economic scars left by conflict, how financial markets have responded to wars, and why the simplistic idea that war is good for business often fails under scrutiny. Before we start, an important caveat. This video is not meant to belittle or minimize the human tragedy of war. The loss and suffering it causes are far more important than any economic number. My goal is simply to understand the economic dimension, because the reality is often more complicated than simple slogans. 1. GDP and output. Why war sometimes looks like growth, government spending, surges, and war production. Economists have long studied how war affects economies. One important and recent contribution comes from the European Bank for Reconstruction and Development, EBRD. Their 2022 working paper draws on a data set of nearly 400 conflicts worldwide over the past 2 centuries, using a method called synthetic control to compare economies with and without war. What emerges is that when a country is not invaded or not fighting on its own soil, GDP per capita sometimes increases relative to what it would have been without war. That's often because of surging government spending, more recruitment, weapons production, munitions manufacturing, infrastructure for war, etc. Wartime production pulls people out of non-market activities, for instance, stay-at-home work, domestic labor, and moves them into paid jobs, factories, military, logistics. The result? In the short term, output metrics can rise, unemployment may fall, and aggregate GDP may show growth. Some historians note that during World War II, US GDP rose dramatically between 1940 and 1945. A 72% jump over 5 years is often cited. Also, some innovations, driven by urgent wartime needs, may accelerate technological or industrial advancement. For some economists, this gives the impression that war can drive innovation. Why that might be misleading. But there's a big catch. GDP accounting and wartime realities rarely align perfectly. As noted by critics and in academic papers, national income accounting, the basis for GDP, often treats war expenditure as positive output. Weapons produced, services rendered, while ignoring the destruction of lives, physical capital, destroyed factories, infrastructure, and unreported non-market losses, trauma, social disruption, lost education, lost leisure. In other words, wartime growth can often just reflect shifting what countries produce, from consumer goods and services to weapons and military support, without capturing the huge human or structural costs. 2. The big picture. Why war usually hurts economies. When we expand the view beyond special cases like the US in World War II to every war in the last 2 centuries, a clearer trend emerges. War on home territory equals severe economic decline. According to the 2022 EBRD study, wars fought on a country's own territory, invasions, civil wars, insurgencies, almost always result in negative economic performance. Their data show GDP per capita drops of over 7 percentage points relative to a synthetic no-war path by the first year after the war ends. A summary of many conflicts suggests that such damage often does not fully reverse. While average drops across all wars, territory loss and overseas engagements are more modest, around 3.7 percentage points in the first post-war year, for a broad panel of 133 country wars. Long-term scarring, consumption, investment, trade. War's economic damage goes beyond a one-year slump. A study published by International Monetary Fund, IMF, finds that 10 years after a conflict begins, GDP per capita is about 28% lower compared to a scenario without war. That drop is driven by massive long-term declines in consumption, trade, investment, and capital formation. Specifically, private consumption falls roughly 25%. Exports and imports collapse. Exports may drop by more than 50 to 60%. Imports by over 30%. Investment in infrastructure, machinery, rebuilding often remains depressed years after the conflict. One brief from the International Growth Center, IGC, estimates that a typical civil war lasting 4 years might lead to an 18% drop in GDP per capita over the war period. 6 years after the war ends, GDP per capita remains around 15 percentage points below what it would have been without war. That shows, once you account for destruction of capital, disruption in trade, flight of talent and population, war rarely leads to bounce back. Why these effects happen? Labor, capital, trade, confidence. Some of the main mechanisms: loss of labor force and human capital, deaths, refugees leaving, reduced birth rates, brain drain. War disrupts education, health, family formation, all long-term human capital losses. Destruction of physical capital, factories, infrastructure, housing, transport networks, farmland. Many get damaged, destroyed, or abandoned. That reduces a country's productive capacity, reduced productivity and investment. Uncertainty, risk, damaged collateral. Investors, both domestic and foreign, often pull out. Credit markets tighten, limiting reconstruction. Trade collapse. Supply chains break. Exports drop. Imports vanish. Countries lose access to global markets, a major blow especially for export-oriented economies. Fiscal stress, inflation, debt burden. Governments often finance war through debt, money creation, or by redirecting spending, leading to inflation and heavy public debt. In short, even if there's a short-term war boost, the longer-term economic consequences are often deeply negative for decades. 3. Case studies and recent data. Camera. Show full-screen graphics of economy war case studies, maybe charts/maps. Global cost of conflict, rough estimates. A recent analysis by the International Security and Development Center, ISDC, estimates that if violent conflicts had been avoided worldwide since 1970, the global economy in 2014 would have been roughly 12% larger. This suggests that the cumulative economic burden of war in lost output, underinvestment, human costs is comparable to major global long-term crises such as climate change or land degradation. Post-Widihud era, 135 wars, 115 countries. A recent study by researchers at the Kellogg School of Management reviewed 135 wars between 1946 and 2023 across 115 countries. Their findings: on average, wars during this period led to a 13% drop in real GDP, an 11% drop in household consumption, a 14% drop in investment, a 13% fall in exports, and a 7% drop in imports. Government revenues also fell by around 14%, while military and wartime expenses rose. Many countries responded by increasing money supply, which led to inflation. In some cases, price levels increased by nearly 50%. These broad data show clearly, across many modern conflicts, war tends to shrink economies and devastate living standards, not just temporarily, but for years afterward. Regional example: Civil War and Subnational Economies. Research on the former Yugoslavia, 1950 to 2015, covering 78 regions, shows how war's impact can vary widely even within one country. Some of the most war-affected regions saw per capita GDP losses of approximately 38%, many of which proved permanent. That underscores that even within a nation, war hits unevenly. Urban centers or capital regions may recover faster. Rural or heavily contested zones may remain damaged for generations. 4. Debt, inflation, and fiscal. Debt and fiscal pressure. Wartime governments often need to raise funds quickly through borrowing, taxes, or monetary expansion. According to data compiled in EBRD reports, it is common to see debt-to-GDP ratios jump by an average of plus 47 percentage points over pre-war levels. Indirectly, this burden carries forward. Servicing debt, rebuilding infrastructure, and financing recovery all weigh heavily on post-war budgets. Inflation, money printing, and currency loss. With revenue down due to disrupted economic activity and expenses up, military reconstruction, many governments resort to printing money. This often leads to inflation, sometimes severe. In the Kellogg study of post-1946 conflicts, inflation sometimes rose aggressively, with price levels up to 50% higher and remaining elevated years after the war began. Inflation erodes real wages and savings, reduces purchasing power, and can depress investment further. A vicious cycle, especially harmful for ordinary households. Credit collapse and investment freeze. War damages collateral, physical assets, reduces investor confidence, and disrupts financial institutions. Studies show post-conflict real investment drops by more than output losses, and domestic credit contracts sharply, sometimes by 20%. When financial systems freeze up, rebuilding becomes much harder. Even if peace returns, investment doesn't automatically bounce back. 5. Markets, stocks, and war profits. Naturally, many people, especially investors, wonder, are there any opportunities during war? Do markets benefit? In cases where the country is not directly devastated, wartime production and government contracts can benefit certain sectors. Defense, manufacturing, supply. That sometimes leads to short-term stock market gains. Some studies show that economies not directly affected by war, or only peripherally involved, may even register temporary gains. But historical evidence also shows volatility and uncertainty. For example, in some countries, war led to near-total equity market wipeouts, asset expropriations, or long-term capital destruction. On a global scale, markets can react strongly to uncertainty, supply disruptions, commodity shocks, inflation, capital flight, all factors that typically weigh on market valuations over the medium term. So while some niche investors or sectors may benefit in the short run, the overall risk and volatility make war a hazardous bet, far from a sure path to business success. Conclusion: what the data actually suggests. So, what's the bottom line? Yes, under certain narrow conditions, no homeland fighting, strong allied backing, big government spending, a temporary boost in GDP or production is possible. But for the vast majority of conflicts, especially those fought on a country's own territory, the long-term economic impacts are overwhelmingly negative. War damages labor and human capital, destroys infrastructure, disrupts trade and investment, and often leads to prolonged debt, inflation, and economic stagnation. Even when GDP recovers or appears to recover, metrics like consumption, living standards, investment, trade, and social welfare often remain depressed. War profits are unpredictable, sector-limited, and carry enormous risks, both for investors and for societies. In short, the narrative that war is good for business does not hold up under rigorous historical and economic analysis. If anything, the evidence strongly suggests the opposite. War tends to be a severe drag on long-term economic and human development. Thanks for watching. If you found this helpful, please hit like, subscribe, and consider sharing. And, as always, I'd love to hear your thoughts or questions below. Stay thoughtful. See you next time on Stickman Speaks.